Imagine you put your entire life savings, everything, into one company's stock. And then that company goes bankrupt. It's happened. It happened to thousands of Enron employees. The company collapsed in 2001. People who'd put their retirement savings 100% into Enron stock. They lost everything. Their entire life savings gone overnight. One basket, all eggs. Basket hit the floor. There's a simple rule that could have saved them. And I'm going to teach it to you today. Diversification means spreading your money across different investments so that if one fails, you don't lose everything. That's it. Don't put all your eggs in one basket. Grandma's advice. Turns out Grandma was a genius investor. If you have $10,000 and put all of it into one company, you're gambling. If that company does great, awesome. If it tanks, you're broke. But if you split that $10,000 across 10 different companies in different industries, maybe even different countries, if one fails, you lose $1,000, not $10,000. And the other 9 might do well enough to cover that loss and then some. Think of it like a sports team. You wouldn't put 11 goalkeepers on a soccer team, right? You need defenders, midfielders, forwards, different positions working together. That's diversification. A portfolio with only tech stocks. That's 11 goalkeepers. Looks fine until someone attacks from midfield. Here's the logic. Different investments react differently to the same event. When oil prices go up, oil companies win their product is worth more. Airlines lose, fuel costs go up. When interest rates rise, banks wins, they earn more on loans. Real estate loses, mortgages get expensive, fewer buyers. When the economy crashes, gold tends to go up, people buy it as a safe haven. Stocks tend to go down. See the pattern? Things move in different directions at the same time. So if your portfolio has oil stocks and airlines, banks and real estate, stocks and gold, when one goes down, another might go up. They balance each other. You won't make the maximum profit, but you also won't take the maximum loss. Diversification isn't about hitting home runs. It's about staying in the game. Okay, practically. Here are the ways you can diversify. Level 1, across different stocks, don't own just one company. Own 15, 20, 30 across different industries. Technology, healthcare, finance, energy, consumer goods. Level 2, across different asset classes, don't just own stocks. Mix it up. Stocks are used for growth. Bonds provide stability. Real estate generates cash flow. Gold offers safety during uncertain times. Cash is kept for emergencies. Each one behaves differently. Together, they create a balanced portfolio. Level 3, across different countries. Don't just invest in your country. The US market might be down while India is booming. European stocks might be flat while Southeast Asian markets are on fire. Global diversification means you're not tied to one economy's fate. Level 4, across time. Don't invest everything at once. Spread your investments over time. Invest a little each month. That SIP strategy we talked about. This way you buy at high prices and low prices, and it averages out. Now, the easiest way to diversify without doing a ton of work. Index funds or ETF. S&P 500 Index Fund gives you a tiny piece of 500 companies in one purchase. Instant diversification. One buy, 500 companies. That's why I love them for beginners. You get diversification on autopilot. Let me warn you about some common traps. Mistake 1, fake diversification. I own 10 different tech stocks. Cool. But you're still 100% in tech. If the tech sector crashes, all 10 go down together. That's not diversification. That's just picking 10 flavors of the same ice cream. Real diversification means different sectors, different asset types, different geographies. Mistake 2, too much diversification. There is such a thing as over-diversifying. If you own 500 stocks, 30 ETF, SES 15 mutual funds, gold, silver, crypto, real estate, bonds, art, wine, it becomes impossible to manage. Returns get diluted, and the fees eat you alive. A good portfolio, 5 to 10 well-chosen, diversified funds can do the job beautifully. Mistake 3, diversifying with things you don't understand. Someone tells you to buy cryptocurrency for diversification, but you have no idea how crypto works. That's not smart diversification. That's blind gambling with extra steps. Only diversify into things you at least basically understand. Let me give you a story that drives this home. In 2008, the stock market crashed hard. Stocks dropped 40% to 50%. People who were 100% in stocks, they got crushed. But people who had 60% stocks, 30% bonds, and 10% gold, their portfolios dropped maybe 15% to 20%. Painful? Yes. Life-ending? No. They recovered within a year or two. Meanwhile, the all-stock folks took 5 to 6 years to get back to where they were. Same financial crisis, same economy, completely different outcomes because of diversification. And here's the thing about market crashes. They always happen. We just never know when. So you can't say, I'll diversify later. By the time the crash happens, it's too late. Diversification isn't exciting. Nobody brags at parties about their beautifully balanced portfolio, but it's the difference between recovering from a crash in 2 years or watching your retirement plan disappear. Here's what to do right now. 1, look at your current investments. Are they all in one stock, one sector, one country? If yes, you're exposed. 2, add variety. Use index funds to get broad market exposure. Consider adding some bonds if you're 100% in stocks. 3, set up monthly investments across 2 to 3 diversified funds. SIP autopilot. Done. 4, don't chase what's hot. The hottest sector today might be dead tomorrow. Balance beats hype every time. Don't put all your eggs in one basket. It's the oldest money advice, and it's still the best. Diversification won't make you the richest person in the room, but it'll keep you from being the poorest. Like, subscribe, and tell me in the comments how diversified is your portfolio right now. Be honest. Let's figure it out together. Catch you next time.